Good morning, everybody, and welcome back to another presentation. My name is Amiel Duncan, and today we are going to be going over itemized deductions. I do want to go ahead and make a note that today this presentation is being recorded. So for anyone that does hop on the Zoom later on into the presentation, and for everyone that's on the call right now, I do ask that you do stay muted and that you turn off your cameras if you don't want to be seen in the recording. So who are we? We are the Taxpayers Help Center, which is a nonprofit organization here in Northridge, California. We operate two tax clinics, the first one being the Low Income Taxpayer Clinic, also known as the LITC. And here we help taxpayers resolve their tax disputes with the IRS. And then our second clinic is going to be the Volunteer Income Tax Clinic, the VITA Clinic. And here we help prepare income taxes for free. There we go. So Masu Shatoni, he is a CPA. He is the director for both clinics. And then once again, my name is Amiel Duncan, and I am the director of the outreach program for the LITC. Now, how can someone get involved or support with our clinics? So individuals and businesses can support us financially by donating funds to help us expand the reach of our services. They can also volunteer their time or expertise, or by spreading awareness about our services. We also help taxpayers both locally here in Los Angeles and nationwide. We are an IRS authorized certifying acceptance agent, so a CAA for the individuals, for the individual taxpayer identification number ITIN applications. So you can go ahead and call us for an appointment to apply for ITIN number or for any other questions or help with any tax disputes. So you can definitely come visit us in office here in Northridge, California at 9029 Reseda Boulevard, Suite 209. You can also reach us by phone at 818-366-0111. We also have a website at www.taxpayershelpcenter.com. And then lastly, to reach out, we also have an email, which is info@taxpayershelpcenter.com. And then today's presentation, as well as previous presentations and future presentations, are all on our Facebook page, which is Taxpayers Help Center, Inc., a nonprofit tax organization. So if you feel that today's presentation was helpful for you and you think that it could be beneficial to someone that you love, go ahead and send them to our Facebook page where they can check out this video and others. Now let's go ahead and jump in to itemized deductions. Now, what are itemized deductions? They are specific expenses that taxpayers can subtract from their AGI, adjusted gross income, to lower their taxable income. Taxpayers can choose between taking a standard deduction or itemizing their deductions. Now, if their standard deduction and allowance that is allowed to all taxpayers is less than their actual deductible expenses, they will benefit from itemizing the standard deduction amount. Oh, so basically, you're going to benefit most from itemizing your deductions if the allowance is less than your actual deductible expenses. So for 2024, the standard deduction amount has increased for all filers, and the amounts are as follows. So if you're single or married filing separately, the amount is going to be $14,600. If you're married filing jointly or qualifying surviving spouse, that total is going to be $29,200. And then lastly, if you are the head of household, that total is going to be $21,900, excuse me. Now, who must itemize? So taxpayers with a standard deduction of 0 should itemize their deductions. This typically includes married individuals filing separately when their spouse is itemizing, regardless of who files first, those filing for a short tax year due to a change in their annual accounting period, non-resident aliens or dual status aliens during the year as well. Now, medical and dental expenses. For these expenses, you could only deduct the portion of your medical and dental expenses that surpasses 7.5% of your AGI. That's reported on Form 1040. It's also important to note that certain medical expenses paid from the estate of a deceased taxpayer can be claimed on the final tax return of the deceased. Now, you can only deduct unreimbursed medical expenses. You cannot deduct medical insurance premiums or expenses paid with pre-tax dollars reimbursed by an insurance company, an employer, or through a tax advantage account like a FSA or HSA. For those who receive the PTC, which is the premium tax credit, only the out-of-pocket premiums not covered by the PTC can be included as a medical expense deduction. So for instance, if the insurance premium is $12,000 and the PTC is $10,000, the taxpayer can only deduct the $2,000 paid out of pocket subject to the AGI threshold for itemized medical expenses. Additionally, taxpayers can deduct any excess advanced PTC they have to repay, but must reduce their deduction by any net PTC claimed on the return. Now, whose expenses are covered? So you can include medical and dental bills that you paid in 2024 for anyone who was in one of the following categories, either at the time the services were provided or when you paid for them. So that would include yourself and your spouse, any dependents you claim on your tax return, your child, even if you don't claim them as a dependent, anyone you could have claimed as a dependent on your return, anyone you could have claimed as a dependent, except that you or your spouse can be claimed as a dependent on someone else's 2024 return. Now, moving on to Schedule A, which is Form 1040, Itemized Deductions. I'm going to basically walk you through this form and what each section of the form is going to look like. So for line 1, which is the medical and dental expenses, you are going to enter the total amount of your medical and dental expenses, making sure to subtract any payments you received from insurance or other sources. Okay, which taxes are not deductible? So not all taxes are deductible and some expenses are not considered taxes. So taxes you cannot deduct include federal income taxes, Social Security, Medicare, federal unemployment, and railroad retirement taxes, custom duties, federal estate and gift taxes, certain state and local taxes, which include taxes on gasoline, car inspection fees, etc. And then lastly, foreign personal or real property taxes. Moving on to line 5, the deduction. Yeah. Moving on to line 5, the deduction for state and local taxes is generally capped at $10,000 or $5,000 if married filing separately. This limit applies to the taxes you report on lines 5A, 5B, and 5C. So, safe harbor. If you donated to charity and received a state or local tax credit in return, you may have to reduce your deduction. However, this rule, the safe harbor, allows you to treat some, if not all, of the non-deductible portion of your donation as payment towards your state and local taxes. So the following conditions apply when it comes to safe harbor. So you have had to make a cash donation to an organization. In return for this cash donation, you received a state or local tax credit, and you must reduce your charitable contribution amount by the value of the state or local tax credit you received. So if you meet these conditions and apply the state or local tax credit to this or previous year's state or local tax liability, you can include that amount on line 5A, 5B, or 5C as applicable. If you apply part of the credit to offset your state or local tax liability in a future year, you can treat that amount as state or local tax paid in the year the credit is applied. Now moving on, or moving more into further detail with line 5A, state and local income taxes. So if you choose not to deduct general sales tax, including the following state and local income taxes on line 5A, state and local income taxes withheld from your salary during 2024, state and local income taxes paid in 2024 for a previous year, such as those paid with your 2023 state or local income tax return, and then state and local estimated tax payments made during 2024, including any part of a prior year's refund that you choose to apply to your 2024 state or local income taxes. Now, state and local general sales taxes, if you want to deduct state and local sales taxes instead of income taxes, make sure to check the box on line 5A. You can figure out how much to deduct by using either your actual sales tax receipts or the sales tax tables, which is provided by the IRS. Now moving on to line B in some more detail. On line B, you're going to write down the state and local taxes you paid on your home or other personal property. So this only counts if the tax rate is the same for everyone in your area and the money is used for general community services. So you're not going to include the following amounts on line B. Taxes on real estate located outside the US, specific service charges like a 20-month monthly fee for trash collection, and then costs for property improvements that boost its value, like building a new sidewalk. Line 5B, continuing on state and local real estate taxes. So if your mortgage payments include real estate taxes, only count the amount that the mortgage company actually paid to the tax office in 2024. If you sold your home in 2024, any real estate taxes that were billed to the buyer should be shown on your settlement statement and possibly in box 6 on Form 1099-S. This amount is considered a refund of real estate taxes. Prepayment of next year's property taxes. You can only deduct property taxes that were both paid in 2024 and assessed before 2025. The assessment date, which is when you become responsible for the tax, is usually set by the state or local laws. And then for refunds and rebates, if you got a refund or rebate in 2024 for real estate taxes you paid in 2024, subtract the amount from your deduction. But if the refund was for taxes you paid in a previous year, don't adjust your 2024 deduction. Instead, report it as an income on Schedule 1, Form 1040, if you previously deducted those taxes and it reduced your tax bill. And then moving on to line 5C, state and local personal property taxes. So on line 5C, you're going to record the state and local personal property taxes you paid, but only if these taxes were based solely on the value of property and were assessed annually. So prepayment for next year's property taxes. You can only deduct property taxes paid in 2024 if they were assessed before 2025. When a tax is considered assessed, it's usually determined by local or state laws, which is typically when you become responsible for paying it. And then line 6, other taxes. On line 6, you're going to enter one total amount, but make sure to list the types and amounts of each tax that make up this total. This should include income taxes paid to foreign countries and certain generation skipping taxes. Don't include taxes paid to the US territories here. Those go on the state and local tax lines. And as well, you're not going to include federal estate tax related to income from a deceased person, as that is going to be reported on line 16. Now, interest you paid. So whether you can deduct interest depends on what you used the loan for. So you can't deduct personal loan interest, but you can deduct interest on home mortgages and certain student loans. So if you use the loan for different things like both personal and business expenses, you need to split the interest based on how you used the loan money. This means tracking what you spent the loan funds um, on to figure out how to divide the interest deduction. Home acquisition debt limit. So the total you or your spouse, if married and filing a joint return, can treat as home acquisition debt on your primary home, and second home is limited based on when the debt is secured. So for debt secured after October 13th, 1987, and before December 16th, 2017, the limit is $1 million, $500,000 if married filing single or separately. And then for debt secured after December 15th, 2017, the amount is $750,000, which is also going to be $375,000 if married filing separately. Line 8 goes into more detail with the home mortgage interest. So on line 8, you're going to put the total mortgage interest you paid on loans for your main home and your second home. So this is going to include the interest on loans you use to buy, build, or improve your home. Points made on these loans, which might be deductible in the year you paid them. So do not include interest on loans that aren't secured by your home or your personal loans. Continuing on with home mortgage interest. A home mortgage is any loan backed by your main or second home. This includes second mortgages, home equity loans, and refinanced mortgages. A home can be a house, condo, mobile home, boat, or similar property, as long as it has basic living features like a place to sleep, a toilet, and a kitchen. And then lastly, if you have one or more home mortgages in 2024 and didn't use all of the loan money to buy, build, or improve your home, check the box on line 8. You can deduct interest on loan money used for other things. Now moving on to line 8A. Here you are going to enter the mortgage interest and points shown on Form 1098 unless there are special rules that limit how much mortgage interest you can deduct. If Form 1098 shows you got a refund for overpaid interest, don't change your deduction for this refund. Instead, you're going to follow the instructions for Schedule 1, Form 1040, line 8C. If you and others paid interest on the mortgage, you can only deduct the part of the interest that matches your share. So interest on Form 1098, interest reported on your Form 1098. So if the Form 1098 you got shows shared interest, only deduct the part that's yours on line 8A. Let the other borrowers know how much they need to deduct. Interest reported on somebody else's Form 1098. So if the shared interest is on someone else's form, put your part of the interest on line 8B, as explained in the line 8B instructions. And then interest exceeding Form 1098, if this is you, you are going, or if you have paid more interest than what's shown on Form 1098, list the higher amount on line 8A. And then you're going to explain why. So if you're sending a paper return, you should attach a note with your explanation and write "see attached" to or next to line 8A. Now moving on to line 8B. If you paid mortgage interest to someone who didn't give you a Form 1098, put this amount on line B. Keep in mind your deductible interest might be less than what you paid if there are limits on how much mortgage interest you can deduct. Seller finance mortgage. So if you paid mortgage interest to the seller of your home and didn't get a Form 1098, you should write down the seller's name, their ID number, and address next to line AB. For people, use their social security number. And then for others, you should use their employer identification number. And then you're also going to want to give the seller your social security number. Now, points not reported on Form 1098. So points shown on your settlement statement can usually be deducted if they were paid just to borrow money. You generally spread these deductions over the life of the loan. Points paid for other things like lender fees can't be deducted. And then when it comes to refinancing for line 8C, when you refinance a mortgage, you usually spread the deduction for points over the new loan's terms, even if it's for your primary home. But if you use part of the refinance money to improve your home, you might be able to deduct some of those points right away. Now we're going to move on to line 9, which is investment interest. So investment interest is the interest you pay on borrowed money for the investment purposes. So it does not include interest related to passive activities or tax-exempt securities. To figure out how much investment interest you can deduct, fill out Form 4952 and then attach it. But you don't need to do this if your investment interest is less than your investment income, you don't have any other investment expenses you can deduct, and you didn't have any disallowed investment interest from last year. Charitable contributions. So with charitable contributions, you can deduct donations to organizations that help with religion, charity, education, science, or literature. Donations to groups that prevent cruelty to kids or animals also count. And those costs or some costs related to Native Alaskan subsistence, bowhead whale hunting might be deductible for whaling captains. So to check if an organization is eligible for charitable deductions, you could either ask the organization, they'll give you, or they can give you proof that they're a legitimate charity, or you can use online resources, so looking up the organization online to confirm its status. And then some examples of some charitable organizations. So for religious ones, we have churches, mosques, synagogues, temples, etc. For community and service organizations, this could be Scouts, BSA, the Boys and Girls Club, Girl Scouts, Goodwill Industries, Red Cross, Salvation Army, etc. For fraternal orders, if contributions are used for charitable purposes, as outlined in the section on gifts to charities. And then veterans and cultural groups, certain organizations serving veterans or cultural purposes. You can deduct donations made in cash, property, or expenses for volunteering with qualifying organizations. If you drove for volunteering, you can deduct the actual cost of gas and oil or 14 cents per mile. You can also include parking fees and tolls. Just remember, don't deduct amounts that were reimbursed to you. And then non-deductible contributions. So you can't deduct charitable donations if you get a state or local tax credit in return, payments to colleges or universities to the right to buy sports tickets, travel costs, including meals and lodging, and then donations to political groups. And then lastly, membership fees to country clubs, lodges, or similar organizations. Now moving on to line 11, which is gifts made by cash or check. So on line 11, you're going to write down the total value of cash or check gifts you gave, plus any out-of-pocket expenses. If there's a limit on how much you can deduct, check the earlier section for details. If you can't deduct everything this year, you might be able to carry over the extra amount to next year. Deduction limits, if there is a limit on the amount you can deduct for cash or check gifts. Now for record keeping. Record keeping. For any cash donations, you need to keep a record like a bank statement or a written acknowledgement for the charity. This record should show the charity's name, the date, and the amount that you donated. For non-cash contributions, on line 12, you're going to enter the total value of any property donations you made, not including cash or check donations, unless there are limits on these deductions. Check the earlier section on deduction limits for details. That was earlier in the slides. If your deduction is limited, you might be able to carry over the excess to the next year. For used items like clothes or furniture, deduct their fair market value when you donated them. This is what someone would pay for them in a regular sale. If you're deducting more than $500, you'll need to fill out Form 8283. The amount of your deduction means the total deduction before any income limits that might carry over to future years. Continuing on with line 12, donations for motor vehicles, boats, or airplanes. If you donate a motor vehicle, boat, or airplane and claim a deduction over $500, you need to attach a statement from the charity to your tax return using Form 1098C. If your total deduction is more than $5,000 or $500 for certain items like clothing, you might also need to get an appraisal and fill out Form 8283. And then donations of clothing and household items. You can only deduct donations of clothing and household items if they are in good and used condition or better. However, if you're claiming a deduction over $500 for a single item and have qualified appraisal with Form 8283, this condition does not apply. And then the record keeping requirements. So if you donate property, keep a receipt or written record from the organization. This should include the organization's name and address, the date and location of the donation, and a description of the property. Almost done with the slideshow. And then lastly, the record keeping requirements for line 12, non-cash contributions. For each property donation, keep detailed records showing how you figured out the property's value when you donated it. If you got an appraisal, keep a signed copy. The cost of the property, especially if it needs to be adjusted based on any income or gain from selling it at fair market value, how you calculated your deduction if you adjusted it for gifts of capital gain property, and then lastly, any conditions related to the donation. If you donate property worth $250 or more, you need a written acknowledgement from the charity at the time of the donation. Just filling out Form 8283 isn't enough. You'll still need to keep all other required records for the donation. Now, line 13, which is the carryover from previous year. If you couldn't deduct all of your donations last year because they were too high, you can carry them over and use them for up to 5 years. This year, the same limits usually apply. However, donations made in 2020 or 2021, there's a 60% limit for 2024. After applying these limits, enter the amount you can deduct this year. And then for line 14, you're simply just going to add lines 11 through 13 up. Now, casualty, theft, and losses, I believe this is line 15. Line 15. So to figure out your loss, complete Form 4684 and attach it. Only put the amount from line 18 of Form 4684 on line 15. You can deduct personal losses from disasters only if each loss is more than $100, or after subtracting $100 from each loss, the total losses are more than 10% of your income on Form 1040 or 1040 SR line 11. And then line 16, which is other itemized deductions. So for increased standard deduction reporting, if you have a net qualified disaster loss on Form 4684, line 15, and you're not itemizing deductions, you can get a bigger standard deduction by one, writing the amount from Form 4684, line 15 next to line 16, and attaching Form 4684. You can also write your standard deduction amount amount next to line 16. And then lastly, adding these two amounts together on line 16 and putting the total on Form 1040 or 1040 SR, line 12. Other itemized deductions. So next to line 16, you're going to list each type and amount of your expenses from the list below and add them up. If you're mailing a paper return and don't have enough space on the form, attach a separate sheet that lists each expense type and amount. So then gambling losses, but only up to the amount you won from gambling, losses from property used to make money, deductions for bond premiums like those for bonds bought before October 23rd, 1986, ordinary loss from certain debt instruments, deduction for repaying money under a claim of rights if it's over $3,000, certain unrecovered investments in a pension, work expenses related to impairment for a disabled person, and federal estate tax on income from a deceased person. These are all other examples of what other itemized deductions that you would add to line 16. And then the total itemized deductions, which is the last line, line 18. If you choose to itemize deductions for the state or other reasons, even if your itemized deductions are less than your standard deduction, make sure to check the box on line 18. And with that, that concludes my presentation on itemized deductions. I hope this was helpful, if not to all, at least one of you guys. And if it was, I hope you guys go ahead and pass this on to a loved one. If you have any questions, any comments or concerns, you can always stay back, ask me questions. You can come visit us in office at 9029 Reseda Boulevard, Suite 209 here in Northridge, California. You can also reach out to us by phone at 818-366-0111. We do have a website as well that you can check out just to get some more basic information on who we are. That website is going to be www.taxpayershelpcenter.com. And then you can always shoot us an email if phone or in person does not work for you. And that email is going to be info@taxpayershelpcenter.com. And then lastly, today's presentation, as well as previous ones, are all going to be linked on our Facebook page at Taxpayers Help Center, Inc., a nonprofit tax organization. And then you can always stay connected with our Facebook to see and stay up to date with new and different upcoming events that we will be hosting. So with that being said, once again, my name is Amiel Duncan. Thank you guys for your patience and your time today, and I hope you guys all have a great day, and I will see you guys in the next presentation. Bye.